Okay, got to be honest with you. The stock market, right. It's like kind of scary, like a casino almost.
Yeah, I hear that a lot. People making millions, then others, poof, gone. Especially starting out, it's intimidating.
So for this deep dive, let's tackle those fears head on. How does it really work? No jargon, just the basics.
Love it. That fear factor is huge. Truth is, it's simpler than it seems. Basically, a system for buying and selling shares of companies, like owning a tiny piece of, say, your favorite store. That's stock.
Okay, so less scary already. But how do prices go crazy? Up, down like a roller coaster?
Not crazy at all. Think of it like a farmer's market. Everyone wants blueberries, suddenly price shoots up, right? Same with stocks. Lots of people want them, price goes up, simple demand.
So like any product, supply and demand, that's it.
You got it. And those ups and downs, they reflect how people feel about the company's future. Will it grow, new products, that kind of thing.
So predicting the future, in a way.
Kind of, yeah. But smart investing, it's not about gambling. It's researching, understanding the business, believing in their long-term success.
Okay, makes sense. But, gotta admit, market crash, that's my nightmare. Invest everything, then bam, it all disappears.
Market crashes happen, that's true, like storms. But historically, it always recovers, reaches new highs. Don't panic. Don't sell everything when it gets rough.
Easier said than done, right.
Hmm.
But if you believe in those companies, you can ride it out.
Exactly. And that's key. Long-term thinking. Big beginner mistake is getting caught up in the short-term stuff. Little dip, they panic. Or chase the hot tip without understanding the company.
So chill out. Think long game, that's what you're saying.
You got it. Legends like Warren Buffett, they made fortunes that way. Solid companies, hold for years, decades even. Steady growth.
Okay, that calms me down a bit. Even the pros ride the bumps. But all that jargon, yikes. Bull markets, bear markets, portfolios, it's like a secret language.
Decode it. Bull market, everyone's optimistic, economy strong, prices generally up. Like a party, good mood all around.
I like parties.
Ah.
So bear market is the opposite then.
Yep. Things are gloomier, economy slowing, more uncertainty. Stock prices tend to drop then.
Got it. Bull good, bear not so good. What about portfolios and dividends?
Okay, imagine your portfolio like a pizza, not
Yeah.
just one topping, right? It's your collection of investments, stocks, bonds, maybe real estate even.
Diversification, right? Like, don't put all your eggs in one basket.
Exactly. Now, dividends are like little bonuses from companies just for owning stock. You get a share in the profits, usually cash.
Getting paid to be in the club sounds pretty sweet.
It can be passive income, essentially, but not all companies do it, and they can change the policy. Keep that in mind.
Okay, lots to think about, but it's making more sense now.
Glad to hear it. That's what we're here for. And speaking of things to think about, there are two markets within the stock market, primary and secondary.
Two markets. Now I am confused.
No worries, it's simpler than it sounds. Primary market is like the grand opening of a company's stock. They sell shares to the public for the first time, usually through an IPO, raising money to grow.
Like when a new tech company goes public, everyone rushes to buy.
Exactly. Secondary market is where you and I come in. We buy and sell from each other, not the company directly. A giant stock exchange party, trading shares.
So company gets the money in the primary, then we regular folks are just trading amongst ourselves in the secondary.
You got it. And prices in the secondary, they fluctuate constantly based on, you guessed it, supply and demand.
Okay, I think I'm getting this. So what are those common beginner mistakes? I want to avoid those pitfalls, for sure.
Great question. One of the biggest is letting emotions drive decisions. Remember that crash we talked about? People panic, sell everything when prices drop, locking in those losses.
So keep a cool head, don't let fear win.
Exactly. Successful investing, it's about the long term, not those short-term ups and downs.
Okay, don't panic. Rule number one. What else should I watch out for?
Another big one is not diversifying. Remember the pizza. You want a mix, not just one topping. Same with your investments.
So even if that hot new tech stock is all the rage, don't put all my money in it. Even if my friend's cousin's brother swears it's a sure thing.
Probably not the best strategy. Diversify across different assets, stocks, bonds, real estate. If one area takes a hit, you're protected.
Makes sense. Diversification, emotional control, got it.
And finally, a lot of people just don't do their research. So tempting to chase that hot tip or get caught up in the online hype.
So don't blindly follow whatever's trending online or what my neighbor says.
Definitely not. Before investing in anything, understand what you're buying into. Research companies, their financials, management, products, competition.
Like dating, right? You wouldn't marry someone without getting to know them first.
Haha, love that. Due diligence is key before committing your hard-earned money.
Research before investing. Check. But so many companies, where do I even start? What do the pros look for?
One thing they focus on is a company's fundamentals.
Fundamentals. Sounds kind of complicated.
Yeah, pretty simple actually. Imagine buying a bakery, right? You'd want to know, are the cakes good? Loyal customers? Good location? Making a profit? Those are the fundamentals, the ingredients for success.
Okay, so look beyond the hype. See what makes them tick, the core stuff.
Exactly. Solid track record of profit, strong management, a product people love.
No get-rich-quick schemes, just good business sense, old-fashioned way.
Exactly. Speaking of old-fashioned, let's talk about two legends, Warren Buffett and Jack Bogle. Timeless wisdom there, even for beginners.
Oh yeah, I've heard the names. But they're like investing rock stars. What can they teach someone just starting out?
You'd be surprised. Both emphasize patience, long-term thinking. Buffett famously said, only buy what you'd hold for 10 years, even if the market closed tomorrow.
10 years. That's a long time to hold on to something.
It is. But the point is, don't get caught up in the short-term swings. Find quality companies you believe in for the long haul.
No panic selling when things get rough. Got it.
Now, Jack Bogle, he was all about index funds, like baskets of stocks that track a market index, like the S&P 500.
So instead of picking individual stocks, I can just buy a fund that holds a bunch of companies.
Right, like a slice of the whole market pie, not just one cherry. Diversified exposure without being a stock-picking expert.
Diversification, check. Less
Ah.
stress, double check. But didn't we say active investing, picking stocks myself, could have higher returns?
True, the potential is there, but higher risk too. More time, research, constantly watching the market.
So like choosing between a leisurely bike ride and training for the Tour de France.
Aha, I like that. Active investing, thrilling but demanding. Passive with index funds, more like a scenic, relaxing stroll. Both valid, depends on you, your risk tolerance, time commitment.
No right or wrong, just different paths up the mountain.
Exactly. Choose what aligns with your goals and comfort level.
Makes sense.
Yeah.
But let's be real, even if I do everything right, isn't there always a chance of losing money? That's what keeps me up at night.
It's a valid fear, but risk is everywhere. With any investment, even a savings account, you risk losing purchasing power with inflation. Manage risk, not avoid it.
Manage risk. How? You need a fancy advisor with a crystal ball?
No crystal balls needed. Understand your own risk tolerance. How much are you comfortable potentially losing? Then choose investments accordingly.
So if I'm cautious, maybe start with index funds, then explore individual stocks as I get more confident.
Smart approach. And remember, diversification is your friend. Spreading investments across different assets reduces the impact if one does poorly.
Diversification, patience, research. I'm sounding like a pro here. But say I'm ready to buy, where do I even go? Needs a briefcase full of cash and a secret handshake.
Thankfully, much easier nowadays. Online brokerage platforms, open an account, start investing with a few clicks.
Seriously, investing from my couch in my pajamas. That sounds dangerously easy. But how do I choose a platform? So many options.
Great question. Got to do your homework there too. Compare fees, minimums, investment options, user experience, even educational resources. Some are for beginners, some are more advanced.
Like choosing a gym, right? Some bare bones, some have all the bells and whistles.
Exactly. Find one that fits you, your needs and goals.
Okay, platform chosen, I'm ready. Any last words of wisdom before I take the plunge?
Here's my final tip. Start small. Don't need a fortune right away. Begin with what you're comfortable with, even a few $100s.
Like dipping my toes in the stock market pool before diving in headfirst.
Exactly. Gradually increase as you gain experience and confidence. Remember, it's a marathon, not a sprint. Get started, keep learning along the way.
This has been so helpful. I went from terrified to actually feeling empowered to take control of my finances.
That's what we're here for. Demystify the market, give you the knowledge you need to succeed.
Okay, feeling more confident about, dipping my toes in. But resources, tools, anything to help me along the way, all this research on my own still feels a bit daunting.
Oh, absolutely. Tons of info out there. Online libraries, financial websites, those investment blogs, even courses, they can be super helpful.
Like a stock market mentor in my pocket.
Exactly. And don't underestimate community. Online forums, investment clubs, connect with others, share knowledge, support each other through the ups and downs,
Great idea. Always good to have support, especially in new territory. Speaking of which, what trends are shaping the market today? As a newbie, what should I watch out for?
Good question. Market's always changing, gotta stay informed. One big thing still is technology. That innovation just keeps going.
So tech is still hot then.
Oh, yeah. AI, cloud computing, e-commerce, renewable energy, huge growth, disrupting everything.
So not just those big tech giants anymore, new players popping up all the time.
Exactly. That's what keeps things interesting. Another trend, sustainability, ethical investing, growing fast.
So investors want companies that are profitable but also responsible,
Yeah.
aligned with their values.
Exactly. People are more aware of the impact. They want their money to do good.
Yeah.
Companies that care about the environment, social responsibility, all that.
That's really cool. So it's not just about making money, but making a positive impact too.
Absolutely. And that's a key point. It's not just charts and numbers. It's understanding the world, the trends, investing in companies that are shaping the future we want.
Wow, that really puts it into perspective. Not just building wealth, but building a better future. I like that.
Powerful, isn't it? Investing becomes more than just finance. It's aligning your money with your values, contributing to positive change.
This whole deep dive has been incredible. Learned so much, not just the mechanics, but the bigger picture too, how it all connects.
That's what we aim for. Remember, the best investment is in yourself, your financial education. Keep learning, exploring, asking questions. It's a lifelong journey. The more you know, the more confident you'll be.
So true. And folks, remember, this isn't just for the Wall Street types. A little knowledge, the right mindset, some patience, anyone can become a successful investor.
Thanks for joining us on this deep dive. Hope you got some great insights and are excited to start your own investing journey.
And remember, the best investment in yourself and your financial future.